It's our Tuesday 3 p.m. again, and we are running we're running a topic called "Run a Business with Your Spouse." We just talked about how to get divorced with all these tax implications. So here we're talking about how to run a business with your spouse, right? That's the fastest way to get divorced, as we know. There is a saying, they say that if you want two friends to break up, have them be in business together. That's what happens. So run a business with spouse is literally a art. It is something that somebody can write a book about for couples who are in business. And in fact, this morning I was just talking about a business. It's a good business, but the couple fights so much. Each one of them was so stressed out. So it is that part of the topic, we leave it for psychologists, right? But I am talking about simply related to taxes. So when you run a business in the household, you and your spouse, and how to deal with this combination, not accidentally increase your tax liabilities, right? So let's just go to there, and I want to guide you through the tax side of issues and opportunities related to that. All right. So this is our website. As usual, you can log into communitycpa.com and see who we are, what we do, get impressed, right? And then we have this long list of who we are. Like we are so many things by numbers, right? 12,000 clients, and we actually have 48 professionals. We are 28 years in service. We have 13 different languages, not just 10. So we have 6 branches. We're just kind of, pretty ordinary, medium-sized CPA firm. On the other than the website, we also have a YouTube channel. The channel name is Community CPA. If you go onto youtube.com, you just put in Community CPA, you will see us. We have this round logo, the circle logo, and it has a little cartoon of me on the first O, and then there is a globe right in the middle, right? So that's a communitycpa.com. That is kind of our logo. And you can come over here to see all of our videos. We have nearly 2,000 videos. We have over 6,000, close to 7,000 subscribers. And so many videos are all educational. We try to give you the knowledge that really down to earth, you just get it. It is something that, you can read book about. You can go on Google, check on IRC code and all of that stuff, right? Or you can listen to other people. Their talk is really dry. It just makes you feel like, no, you don't want to listen. But in our videos, we are very down to earth. We just tell you what it is. Sometimes I have people tell me that, Ying, if you tell everybody what you do, what are you going to do? I will have a nice job. I'm just going to watch all of you doing my job, so I don't do it anymore, right? So it's a place we share. Selflessly. We just give you what we know. And if we know little, we share little. If we know more, we share more. So that's just how it is. And 2 books. I wrote 2 books. I have 2 more to go. And I hope I can pull out the other 2 soon. Not easy. Because I'm writing these books kind of mirror what I do, like in the business. So I started Community CPA, I grow it, and I expanded it. But the expanding of the business 2 p.m. in this particular environment, things are changing. When I wrote the second book, I was going through a pandemic. Now I'm going through tariff tax and stuff, all these changes and the immigration rates. And, we just had 475 South Koreans are getting deported. And it just, a lot of things is interfering with the understanding of how to run business, how to expand the business. So it's hard to finish the book, but I'm trying. The last book I have in this business series is the 6 p.m., which is retiring from your business. So far, I have not really had any content for that. like I said, I'm going through the journey myself, right? So I can reference to myself. If I am not mentally there yet, it's hard to write about it. So I don't think I will write the 6 p.m. anytime soon, but the 2 p.m. should come out. All right, no responsibility disclaimer, folks. Just make sure you take responsibility of what you learn on internet, okay? All right, operating a business together. Do you and your spouse operating a business together, right? You might face some challenges, right? Some people goes, what are you talking about? Challenges? It kills me. Oh yeah, a lot of challenges. But I mean challenges related to taxes. So in our webinar today. So not just challenges like you face and, your spouse doing things you don't like to see, stuff like that. I am talking about the challenges in your preparation of tax return. So you run a business together and you have, you just sit there wonder, I felt like all of my earnings went to IRS because I paid so much taxes. Good question. Maybe you're being challenged. Maybe you did not quite get it. Maybe there is tax saving opportunities for you, and it's right here, right now with Ying. And then listen to me. Let's go to see solutions I gave you. There are 3 solutions, okay? And in this webinar, we'll identify, focusing on issues, identifying tax issues, and also discovering opportunities, okay? We will give you real life experience, and I have so many real life experience. I'll pull them out at the right time. Okay. As soon as you say, yes, we're running business together, you are in a partnership. Am I right? Partnership. So a incorporated business with your spouse is classified as a partnership for federal income tax purposes. So you, as a partners, formed a partnership. Doesn't matter you registered or not, incorporated or not. It is a partnership return. It is not 1040. It is 1065. Form 1065. You and your spouse must issue a separate K1. So you're going to get a K1. Your spouse going to get K1. On the K1 is allocates the partnership's taxable income, deductions, and the credit between 2 of you. Okay? So this is the only beginning of a unwelcoming tax complications. So yeah, you run it together. There you go. You are in partnership. So let's understand the self-employment tax, right? In partnership, you both are working in the business. What the equal sign, when I say you both are working in the business, equals to you both would pay self-employment tax. Then you may say, Ying, I want to know what is self-employment tax. Self-employment tax is in addition to income tax. They're not the same. You may be paying 20% on income tax. Self-employment tax is another add-on. Okay? So if you pay top tiers of income tax 37, you add your self-employment tax, you're 42%. Yes, self-employment tax is 15.3%. 15.3% total self-employment tax. Okay, that is 12.4 Social Security and then 2.9 Medicare. It is also have the threshold on the Social Security, which is the money you made as long as it's not more than $176,000 in 2025. That is the only one subject to the 12.4. So let's just make matters simple. I want you to remember just one number, 15.3%. And if you want to be even simpler, just do 15% for budgetary purposes. So that way you know, oh, self-employment tax 15%. So if your spouse makes money, you also do, and both of you are working in the company, then you're double whammy on the self-employment tax, right? Yours and your spouse's. So you have 2. With your joint 1040, you will see the effect even more traumatized because yours come in your spouse is coming in, and then your self-employment is also each individually coming in, and then that will really see the tax. No wonder some people will come to us goes, Ying, I am just busy whole year and to take care of IRS, because I paid all of my bottom line to IRS, and somehow somewhere I heard that our president don't even need to pay income taxes because he had such a magical things going on in his taxes. He doesn't need to pay. There's no magical things, ladies and gentlemen. It is just what was done in the tax return based on what the tax code stipulates, right? So this is why we talk, because we don't want you to end up doing that. We want to give you solutions so you don't end up paying self-employment tax on every penny and you earned in this partnership, right? So with that said, we want to look at an example. So this will clear your thought in terms of the self-employment tax. Okay, let's see how self-employment tax works, right? Let's say you and your spouse each have net profit of $150,000 in 2025, right? You made a total of $300,000 profit because you are 50-50, so each one of you had $150,000. Now, self-employment tax, it is $150,000 times 15.3% times 2, because each one of you made half of the amount. So that is $45,900. This is the taxes you have to pay without considering your income tax. $300,000 total income, that probably drive you about $60,000 federal tax. So $60,000 plus $45,000, we're talking about nearly $110,000 is going to taxes, right? Because you made a $300,000 minus $110,000, so you take home $190,000. Aren't you happy about it? You say no, right? But this is what happens when you are not knowing the issue and you are just doing what it meant to do, right? By the book, without tax strategy, without tax planning, without structure changes that could make a day and night difference for you, right? But of course, in here, I wasn't really scientific about a little adjustment. For example, the $45,900, you actually can take half of that, which is what, $23,000. You can take that to reduce your income. So that is a calculation inside of your 1040. But let's ignore those, secondary calculation. I just want you to really focus on the fact is, if both of you work in the business and 50-50, and both of you check the box goes, yes, I work in the business, then that means you both are paying self-employment tax as a together, and we calculate one person, we calculate the other person, so your household is going to pay $45,900 taxes on self-employment tax, add on top of the income tax you're supposed to pay. A lot of taxes. It's really not, it's not realistic for small business to end up in this way. But this is a reality for people who doesn't work with community CPA. I'm not kidding. That's what that is. All right. I gave you 3 solutions. So this is my number 1 solution. Number 1 solution is not me resolving it. It is more of me giving you a concept, okay? And, I want you to use the IRS approved method to handle this self-employment tax and in a community property state. So what is community property state? There's only the following states are community property state, okay? Arizona, California, Idaho, and Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin, and Alaska. Alaska optional. So, among these states, California, we have a branch. Texas, we have a branch. So Iowa is not. Minnesota is not. So community property state is a state where treat most of the property acquired during a marriage, during your marriage time, is considered jointly owned by both spouses. Okay? So regardless who earned it, who purchased it, who made it, and whose company, who is doing what business, it is considered both. So with that said, and if you use this guideline, which is Revenue Procedure 2002-69, there is an exception to the general rule that the spouse-run businesses are treated as a partnership, and for federal tax purposes, you can treat that unincorporated partnership in the Schedule C as a sole proprietorship. You don't have to file a 1065. You can just dump that in the 1040 under Schedule C. So by doing so, then your Schedule C, on your Schedule C, that is one person's income. If it is one person's income, remember there's a threshold of $176,000. That is like the social security, the 12.4% would not calculate. Remember. So if you made a lot more money, then you at least save some self-employment tax. That is where I am driving to. So basically on your 1040, when you use Schedule C, you have to name one person as the one conducting business. But if you are truly a partnership, but you are in the community property state, you don't need to argue. You can just put that on the Schedule C. You save 12.4% Social Security on the portion that going over $176,000. Yeah, that is a saving, right? So it can cut your self-employment tax bill so you don't have to pay double and making it $45,000. You can just pay half of it. Make sense? All right. So that's my solution number one. It's quite related to the state rules and regulations, their laws, right? So you can easily search out whether your state is a community property state, which I already told you: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin, Alaska. Alaska is optional community property state if the spouses opt in, if the other party agrees. So it has that in there. So with that said, let's just look at our solution number 2. Solution number 2. This is quite easy to grasp. You know, when you are partnership and each one of you working, then you pay self-employment tax. But if you convert that partnership to S corporation, then the net profit you left over that you divided among you two is no longer subject to self-employment tax. You walk away from that $45,000 altogether. But is that the end of it? No, there is a condition before that. You must pay a reasonable salary to both of you or to one of you who is working, right? If you and your spouse, not in the community property state, consider converting the business into S corp. That way, only the salary you pay yourself or you pay to your spouse is paying for Social Security, Medicare. Of course, this needs to be reasonable. But then the rest of the profit you got. So, for example, that $150,000 profit you and your spouse each got, right? $150,000. But let's say your business is lawn mowing. So if you hire someone to mow lawn full time, how much salary would you pay that person? Maybe $50,000 a year. Am I right? That means $50,000 you pay Social Security, Medicare, but the other $100,000 for one of you, it become a distribution. You don't pay self-employment tax. That is immediately $15,300 savings on each one of you. So two of you saved $30,600 just by even running your brain. You already saved. Easy, right? So that is solution number 2. Then you want to make sure that and you are converting if you are not in the community property state. You know, like I said, it has to be reasonable. You cannot be saying, oh, we both are attorneys, so we just gotta pay ourselves $25,000 on the W-2. Then the rest of millions is gonna be distribution. Then we don't pay self-employment tax. That's not reasonable pay. A attorney's reasonable pay range from $100,000 all the way to $500,000. It really depends, right? So that is where if you convert to S corporation, go ask your CPA. Come to community CPA, get that all sorted out, decided, and what payroll to run before you really jump into S corp. All right, what is our number 3? Number 3. So we talked about number 1, if you are community property state business, right? Number 2, and we were saying that if you're not converting, right, to S corp. What is number 3? Number 3 is to break up your partnership. Hire your spouse as employee. And you can disband the existing spousal partnership and start running operation as a sole proprietorship operating as a one person. All right? And then this is very useful. Let me tell you this. So let's say you decided to stay in a partnership. And, you decided that I am just, I'm going to pay myself. The self-employment tax is going to be on me. Whatever my spouse is doing, I'm just going to treat my spouse like one of the employee. That is super good. That is fine. So you can define how much you pay to your spouse, then yours becoming a self-employment taxable, right? You can hire your spouse as employee, and you can even giving your spouse benefit, like set up 401k plan, set up cash balance plan, if you got too much cash to burn, right? So that is really what you can do to just turn your other half to an employee. Take that other half out of the ownership. Don't let even have the other half in business like business owner. Just break up the partnership, making that just you, and you pay salary. And when you do that, folks, when you run payroll, it is not just paying Social Security, Medicare, those kind of taxes. It is all the employee-related related benefit would come in. Company paid medical insurance, company match for 401k, and a company profit sharing, and a company cash balance plan. My goodness, you could have, if you pay your spouse $100,000 on salary, then you could end up with $70,000 on retirement benefit. You could end up with another $100,000 on cash balance plan. You could end up with $50,000 worth of, medical insurance and also medical whatever expenses, because those are all company benefit for the employee. And then at the end, you got all your profit carved out. It went to your spouse's pocket. Let's just hope your spouse don't get divorced with you right away. So then you will be smiling, right? And of course, if they did, those are their money. And if you put in all the money to your spouse, run lean on your side. And if divorce comes, and you hear my other talk, so, it is very possible you just did it to enrich your spouse so your spouse can find somebody else. I'm just kidding. Who do that, right? I have never met anybody who doing that, so I'm pretty sure that doesn't exist. All right. Now, So we got three solutions. Three solutions, and these solutions you got are helping you to reduce your taxes. You know how happy you will be when you ended up with, $110,000 taxes while you're making $300,000. Imagine that slashing to half. Then you will be happy. And the marriage will stay strong. The business will prosper because you got your cash flow. Okay? So, this is where we say that, in being a single member LLC, hiring spouse, that means you can have these self-employment tax only calculated on you, and for your spouse is limited to the W-2. Right? So that way, and you may even be able to provide all these expenses to your spouse. So that enhances our number 3. So our number 3 is a big deal. A story. We have long time ago, this is at least 15 years ago, and there was a couple who runs a lot of hotels in our area. They have a lot of hotels to run. And every hotel they have is LLC, is a partnership. So the partnership between husband and a wife. So when they come to me, obviously their taxes were charged self-employment tax for both of them because the preparer was assuming both of them were actively working in the hotel. But when I got hold of this case and I was talking to the wife and the husband, so I was asking the wife, I know what the husband do, and obviously he's headstrong and I can tell that he managed the business. But the ladies was very reserved and quiet, so I asked her, what do you do? I was expecting her to tell me that, I clean the hotel rooms and things like that, right? But she looked at me and goes, what do you mean? And I said, what do you do for the hotels that you own? You have ownership on that. She goes, I don't do anything. I don't even go there. I don't know what he does, but I don't do anything. What does that tell you? When someone talks to you like that, that means they are not actively involved in the hotel. That means she is a passive member of that LLC. That means she should not be paying self-employment taxes all these years. So we made changes, right? I didn't really bother to go back to correct the past, but I did my part right. And guess what? If I ask you to give me a guess on how much we saved every year on a change like this, that total number was $60,000. So that is how significant that is to recognize which person should pay self-employment, which is not. All right? So to really conclude this, I want you to be flexible in thinking. And when you and your spouse get into any heated discussion, if it is money related, think maybe you're paying too much taxes. Maybe instead of going to marriage counselor, you should go to tax planning session with community CPA, right? So I really think a lot of household issues stemming from, you know what I mean, money. If the money is there, if there's no cash flow struggles, there wouldn't be any issue for a lot of people, a lot of couple. So, but in this case, you got into issue. Of course, money is a fire. It's oil on the fire. It just makes it worse when you're short of money. All right. Questions for community CPA? And we can help you. Having a profitable business with your spouse that classified as a partnership, and knowing self-employment is something to look into. Okay? You can work with us to decide whether you should use solution number 1 or solution number 2 or solution number 3. Let's make sure that you actively considering that. Now, Our partners is right here in front of you. This is on our website. If you click that appointments button, you will see us and you can book our time, folks. You can book our time. We come on, we answer questions, and you get your issue resolved. And here is our overall contact information. Other than the YouTube channel, please subscribe to our channel. And you also have an email that is Catherine@communitycpa.com. She is our marketing manager. She knows to bring your issue to the solution through this free channel. So we always try to answer your question. And our overall number is 515-288-3188. We open 6 days a week, Monday to Saturday, all year round. So there is no tax season for us. Every day is our tax season. I will talk to you again on Saturday, folks. Talk to you. Bye.